Good afternoon and welcome to today's virtual seminar. My name is David Aikman. I'm the director of the Qatar Centre for Global Banking and Finance here at King's College London. It's my great pleasure to welcome Saleem Bahaj from the Bank of England to give today's talk. This is a joint piece of work with Ricardo Reis from the LSE. I've known Saleem for a number of years, and he really is one of the very best young economists working in central banking today. So Saleem, we're actually absolutely thrilled you can join us and give this talk. Before I kind of hand the the screen, I should say, to Saleem, let me say a word or two about the kind of rules of the game, how we'll run it. So this is a 60-minute seminar, so we'll end at 3 p.m. London time. Please feel free to ask questions, questions of clarification in the Q&A box, which is at the bottom of your screens, during the talk, and Ricardo will be handling those questions while Saleem is talking. Other than that, Saleem will talk uninterrupted for 45 minutes, there or thereabouts, and we'll leave 15 minutes time for a wider discussion at the end. Now, if you'd like at the end, if you'd like to raise a question, I'd invite you to kind of raise your hand. So that's like an option again at the bottom of the screen here. And if you like, you can ask the questions yourself directly over audio. Bear in mind, this is being recorded, so your question will be later posted on our kind of channel. Equally, if you prefer, I can relay the questions myself, but put those also in the Q&A box. So without further ado, let me hand over to Saleem.
All right. Thank you very much, David and Francesca, for inviting me and for your kind words. It's much appreciated. Thank you. So as David said, it's joined with Ricardo. He is floating around virtually too, and we'll be taking on the Q&A via chat. And towards the end of the talk too, I'll be giving the presentation. And Bank of England works. We have the normal disclaimer at the bottom of the slide here. So the paper is called Jumpstarting an International Currency. It's actually useful to dwell for a minute or two on the title itself and define these terms. So by international currency, what we really mean is a currency which is being used outside the borders of the issue, as it were, to facilitate transactions across borders, so like the yen or the euro, or most typically the dollar, which is the dominant currency in the international financial system nowadays. But we're not focusing on dominance in particular. I mean, there's a big literature on that and why the international financial system is pushed towards having a dominant currency. Instead, we're focused on this sort of jump-starting term, the idea that how do you go from a currency which is just used domestically to one actually it starts to be used across borders? How do you shift from doing that as a country or as a central bank and make your currency be used outside of your borders to facilitate international transactions and in particular trade in our context? Okay, and we're sort of inspired to look into this question by, I guess, a whole host of sort of historical economics papers by Eichengreen, in particular, his co-authors. And I want to sort of start by drawing a historical parallel which sort of lives within his work. So think about the dollar back in 1912 and the US's situation. Okay, so in that period, the US was the world's largest trading nation. Okay, it was the biggest exporter, the biggest importer. But actually, most trade, almost all trade they did, was not funded in dollars. Okay, and the reason for that primarily was because international trade is a really working capital intensive activity. You need to borrow because of shipping times, etc. You have to borrow to fund it, and the market for doing that, the market for trade credit, trade acceptances, was sterling denominated, and it was all based in London. Okay, so basically, the trade was happening in sterling and GBP and funded through the London market. In 1913, things started to change. We had the Federal Reserve Act, okay, and Benjamin Strong at the New York Fed, the first president of the New York Fed, really had this idea he wanted to push for the for the dollar to be an international currency, okay? And there were three sort of main activities that took place. The first was the deregulation of the US banking system. So suddenly US banks could branch abroad, okay? And so you actually could set up the correspondent accounts that enabled dollars to flow across borders via international banking, the plumbing, as it were, of the international currency, okay? The Fed was established with a goal of having a stable exchange rate and stable inflation, okay? And last, and sort of a particular focus of what we're interested in was this idea that, you know, they wanted to have the stable provision of trade credit in dollars, okay? And how I did that was by establishing sort of liquid secondary market for trade acceptances in New York. So trade acceptances are sort of the securities that are generated through trade credit. So I'm an exporter, I want to sell some goods. I say that I've sent these goods across, I get a trade acceptance, I go to my bank and I can borrow against that acceptance, essentially. What the Fed did was create a secondary market by acting as like a buyer of last resort for those securities, okay? And by some measures, this was a very active policy, and actually it held around sort of 2/3 at the peak of these trade bills in New York, okay? So it created a very liquid secondary market and made sure that trade credit was available in dollars, okay? And the outcome, you know, we kind of know now, given where we are, it's 100 years later or so, or more than that. By 1925, the dollar was you know, competing with the pound for international transactions. By 1945, it was a dominant currency, and it still is today, right? So the question we have in mind when sort of starting this paper is, what was the role of policy in this? I mean, were these activities crucial, or was it really the fact that, you know, the London market was devastated by a couple of wars in the intervening time period? Or was it the case that, you know, the US was the largest economy in the world by 1945 by a substantial margin? So this is an inevitable consequence of America being the largest economy and also the largest creditor in the world by 1945. If you then fast forward to China in 2009, actually the parallel becomes quite clear, right? So it was about to become the largest good exporter in the world, okay, and it was a major creditor, but basically, you know, we had capital controls and almost no international payments or trade was denominated in RMB, okay? And starting in 2009, in July, the PBOC and the Chinese authorities tried to change that. They did a number of things, and these things actually sort of parallelized quite well with what the Federal Reserve did. The first was sort of set up the plumbing of a trade system, payment system. So they had a trade settlement pilot scheme, which enabled trade to be dominated in RMB and money be transferred through the capital controls. They set up an offshore market for RMB payments in Hong Kong, the CNH currency. They also embarked on a stable exchange rate policy. You know, we had dollar peg initially and now managed float. And they also acted as a buyer of last resort for trade credit or trade acceptances. And they do this via their swap lines. Essentially what's happening is these swap lines is that they lend, or PBOC lends RMB to a foreign central bank, and that central bank can then use those RMB to support its own banking systems in providing RMB trade credit. Okay, so they're acting in a very similar way to what the Federal Reserve did, except that they rely on an intermediary central bank to do it. Okay, the outcomes, okay, fine. The RMB today is not like what the US dollar was in 1925, but still, you know, the IMF included it in the SDR basket in 2016. It's now a fraction of foreign exchange rate, foreign exchange reserves, so 2% in 2019 compared to 0 in 2009, and it makes up around 3% of global payments too. Okay, so it's starting to rise up on this completely zero base compared to where it started from just a decade ago. Okay, and so the question we have is it, you know, coincidence, luck, or is it the same set of policies here as in the US in 1912 that helped the currency rise? Okay, so that's sort of the context of the paper. Let me explain how we sort of attack this question. So what we have is a sort of theoretical section and empirical section in the paper. The theoretical section is a model of a small open economy where you have a continuum of import-export firms, which both have to choose the currency under which they want to denominate their exports, okay, and the currency in which they're going to denominate the working capital and inputs and trade credit, which are used to produce those exports, okay? And the complementarity in that choice is going to be key. They want to align those two currencies, and therefore policies that push firms to use a particular currency for this, then encourage them to use that currency for invoicing, for exports, etc. And in a focal situation where there's a rising currency versus a dominant one, so R is going to be our China, RMB, etc., and D will be dominant for dollar. That's sort of how it works. And the point is that, you know, if the credit in this rising currency is cheap and liquid enough, so it's not very variable, in expectation it's low, so the interest rate is low, it's not volatile. If the exchange rate is sufficiently stable and that currency has a high covariance with domestic inputs, there can be a jump start, okay? And that currency can start to be used. And the key point is that if a central bank like the PBOC or even the US 100 years ago focuses on making credit in a particular currency, its particular currency cheap enough and liquid enough, that can help trigger this jump start of the currency being used. Okay, that's sort of the key conclusion from the model. And then we sort of interpret, as I said, these PBOC swap lines as a policy like one, okay, like point one here, a way of making credit cheap and liquid and not very variable. And you basically look at spatial and temporal variation in the signing of those sort of agreements, so which countries signed them at what time, and control for various other factors that may go on that signing of those agreements. And basically the idea is that once you do that, you can see that actually, yes, this policy seems to work. Sign the swap lines, increase the probability that the RMB is used by a country by 20% in a given month. Okay, so it seems to have this jump start effect. That's sort of the paper in a nutshell. Okay, so let me just jump directly into the model because I haven't got a huge amount of time during the talk. So it's going to be a 3-period model. In period 0, there's the firm that's this import-export firm that's operating in this small open economy makes 2 choices. Okay, it chooses the composition of its inputs, so it's a technology choice. It sort of chooses how it's going to compose the inputs that it's using, and there's a choice between R inputs, so rising currency or Chinese inputs, as it were, versus D inputs, so buying from the US and sort of the way of interpreting that in the model, outside the model. And it also chooses the price it's going to charge in the particular market it's exporting to. So that can be in D and R, in the local currency, or in the producer currencies, the currency that the firm is located in. And that's market specific, okay? And it does that knowing the average interest rates for all the currencies and the relative costs of inputs, okay? In period 1, the firm produces, so it buys imported inputs from R and D using this committed composition. And the key point is that, you know, this is a working capital type model. It has to borrow in advance to pay for these inputs, okay? And it borrows from a matching currency. So we're going to force by assumption the currency matches in this sort of baseline version of the model. But, you know, obviously the firm actually wants to try to eliminate mismatched currencies itself. So if you allow it to be a separate choice, it will always choose to match. So actually this is not a very strong assumption. And at that point, all sort of exogenous risk realizes on exchange rates, and the firms also face their own idiosyncratic risk in obtaining the working capital in a particular currency. Okay, so you can interpret that as saying, look, I'm not sure how easily my bank can provide me trade credit in RMB, for instance. And that's an exogenous shock that can hit me harder than, say, another firm with a different banking relationship or something like that, okay? It's sort of like a financial friction which we sort of leave outside the model in that sense. In period 2, the firm then sells its goods to reach markets and collects revenue and then repays the debt credibly and distributes profits. So this is a completely mechanical period. So all the decisions in period 0 and period 1 just lead to an outcome in period 2. And since this is a kind of a standard sort of working capital model, you can think about quite easily extending this, at least we conjecture, you can extend this to an infinite horizon model with working capital. So 2 intra-period choices, one at the beginning and one at the end of time t, and proceed on that basis rather than having it static. But for our purposes, 3 periods is sufficient to get the points you want to make. Fine. So then let's think about how this firm fits together with the wider economy. So imagine this firm is located in some emerging market, call it say Thailand, for instance, just for completeness, and you have J equals 0 to J equals 1 firms, so some continuum of firms. Each individual firm exports to a set of small open economies, I equals 0 to 1. And then there's 2 chunky markets that could also export to the R market, so China, for instance, and a D market, the dominant market for the US for completeness. Okay, and just to sort of help understand what these boxes mean, these firms and markets are indexed by, firstly, how stable their bilateral exchange rate is. So the country down here will have a very volatile exchange rate with, say this is Thailand at the bottom, have a very volatile exchange rate with Thai baht. The market up here would have a very stable exchange rate, maybe a peg with the Thai baht. So maybe this is Malaysia, this is Peru, or something like this as a way of interpreting this index. And then the firms are indexed by how volatile their funding risk is. Okay, so this firm here may know that it can obtain credit in R very easily. This one up here is slightly more worried. Okay, so that's how to interpret these boxes. Okay, so just to put some more concreteness around the model that I laid out in the diagrams. So this choice of technology, this period 1 choice, is essentially equivalent to choosing the convex combination of R and D inputs you're going to use. So the firm is going to use a total and imported input xj, okay, that's J's use of imported inputs, and it chooses in period 0 the eta parameter which governs the share which is R and the share which is D. Okay, so how much do I buy from the US, how much do I buy from China? That's the way of interpreting it. And obviously, ex ante, they're perfect substitutes, not imposing anything in terms of like the degree of substituting between the 2. Well, so we are, we're sort of saying they're perfect substitutes. But ex post, they're perfect complements, right? So they student have to sort of stick to that convex combination, okay? And then, so in period 0, it chooses eta, but it will produce in period 1 using this Douglas production function, which takes these imported inputs and combines them with some domestic inputs, so domestic labor, for instance, LJ, okay? And the key point is that, this it can pay for in period 2, this it needs to pay for in period 1 because it's imported, and so it has to borrow to do it, and we're imposing no currency mismatch. As I said, you can separate that choice. The firm will still want to sort of align the currencies anyway, and you can go beyond Douglas. It doesn't really change very much. And then also in period 0, it's choosing its different pricing regimes. So for each market, it's choosing between producer currency pricing, so pricing its own currency, local currency pricing, so pricing the currency it's exporting to, or the market it's exporting to's currency, DCP, so the dominant currency pricing, or RCP, the rising currency pricing. Okay, and then obviously here are the revenues it will get, where SI is a local exchange rate with, say, the Thai baht in my example. That's the dollar baht exchange rate, and then there should be an R there. Sorry, that's the RMB baht exchange rate. An assumption we're going to make is that these exchange rates are log normally distributed. That's just to get analytical results out of the model. You can relax that, but then you're relying on approximations to solve things. It doesn't really change very much. What you do is approximations, and there's a proposition in the paper that goes through the analytics on that. The other assumption we're making is that mu D equals mu R, so the mean expected exchange rate D and R is the same, and so is the volatility. This assumption here you could perhaps replace with, say, imposing a UIP condition, having an interest rate differential instead. But in the end, it's probably a little bit heroic, but it helps us get analytical results and sort of focus on the mechanisms that we're interested in the paper. Fine. And then in terms of what happens in period 1, as I said, the firm has to borrow to fund its inputs. We're going to normalize the D interest rate to 1, and it's the R interest rate that bears this idiosyncratic risk at the firm level, which is this epsilon J here, which has some firm-specific distribution attached to it. Okay, GJ epsilon J. And this is a idiosyncratic risk, so it's not correlated with any exchange rate risk, etc. It's a firm-specific shock, the variability of credit in R and D. Okay, or R, sorry, I should be clear. The firm then pays a price rho D for dollar inputs and the price rho R for R inputs. And in addition, it has this domestic non-credit input L here, and the price of that's going to be W. Okay, it's a wage, if you think about it in domestic currency terms. And what's important, and I'll show you why in a few slides, is there's a covariance between W and the exchange rate in dollars, RMB. Okay, and I'll discuss why that matters, but the key point is that that's going to govern how much the two potential inputs co-move in the firm's sort of marginal cost function, which is written here. So this is the cost of domestic inputs, and here is the cost of imported inputs with the weight E to J on R inputs, which have an exchange rate SR and this interest rate risk attached to them, and D inputs, which have no interest rate risk, but depend on the exchange rate SD. Okay. And then in period 2, it's just a very standard situation. The firm has a CES demand function. So this is revenues. If you have LCP, if you have RCP, there's an exchange rate risk there because of the exchange rate moving in different directions. You can go beyond the CES and add, say, complementarities in demand as well. It doesn't really change very much of the conclusions in the paper. Okay. And the key point is, given this setup, is that okay, the firm is risk neutral. Okay, it just maximizes expected profits here, but it wants to minimize deviations from its optimal price. Okay, and its optimal price, if we have a CES, is a fixed markup of a marginal cost. So it wants to make sure that prices and marginal costs align. Okay, and shocks to exchange rates, to input costs, the borrowing costs can all move the optimal price and optimal marginal cost around and cause a separation between revenues and marginal costs, and that's costly for the firm. So it wants to make the choice of its working capital and its pricing to minimize that. Okay, that's the idea. And so let's just go through what the price it will choose looks like. I mean, this is actually very standard from the sort of new Keynesian open economy pricing literature, say like Charles Engel's work or E.T. Goffman's work. So let's think of a firm that's choosing LCP, PCP, RCP, DCP, but it's already chosen its composition of its input. So it's going for R credit. It's going to import using the rising currency. Okay. We get 3 results, which are very, very intuitive. The first is that the firm always prefers RCP to DCP. The firm wants to align prices of marginal cost and avoid costly deviations. So if its inputs are denominated in R, why would you choose DCP? Basically, that's what that's saying. The second one, which is slightly more interesting, is that it will choose RCP relative to LCP, so pricing in the local currency, if the variance in the local exchange rate is sufficiently high, okay, which is what this expression here is saying. And the idea is that if you're Thailand and you're exporting to Peru, the Peruvian currency is going to move around a lot, so that variation could be costly. You make a mistake, and it doesn't make sense to sort of export in Peruvian currency. But if you export to Germany and the euro is very stable, okay, fine, you can price in euros. You're more willing to do that, or indeed in the currency of your inputs, which is going to be R. Okay. Last is that RCP is preferred to the producer currency, so that's the Pi Baht in my example, if our inputs are sufficiently important in production. Okay, so alpha is high, so a lot of my inputs are always denominated in R, or the sigma RW is sufficiently high. So the cost of those other inputs also co-move with R. Okay, so there's sort of two other channels that can push you towards RCP versus PCP. And I'll come back to this sigma RW term in a few slides. Okay, so given the choice of P, the question is what happens to the choice of credit. And this is a bit more novel because we're sort of introducing this working capital channel into a sort of standard Keynesian sticky price open economy choice model. This gets more novel results. The first thing is that the firm is risk neutral, so it has no reason to hedge fluctuations in marginal costs in isolation. So it doesn't need to necessarily have a convex combination of dollars and RMB in its input prices to make marginal cost fluctuations smaller. So basically, it chooses a corner solution, or it chooses one or the other. Okay, that sort of arises from the outcome. I choose R or I choose D. I go for one or the other. Okay, and the firm will choose R credit, E2 equals 1, if this threshold result here is satisfied. And on the left-hand side of the threshold, what we have is a term here which basically says, okay, how volatile and how expensive is trade credit in R at the firm-specific level? So how big is this shock, epsilon J, to my cost of borrowing in R? If it's very noisy, I don't want to borrow in R. If this expectation here, which is really a geometric mean, is sufficiently low, then I'm willing to use our currency. On the right-hand side, we have a threshold which depends on interest rate differentials and price differentials in a very intuitive way. So if the cost of our borrowing is as high on average, I also don't want to choose our credit. But this term here is sort of a term which has more interesting things sort of contained in it. And it's larger, the larger the share of markets in which the firm uses the R currency. So the idea is that if I'm using the R currency a lot, then my prices, my revenues are denominated in R. So I want to align my marginal cost with that. So I'm more willing to use our credit in the first place. Okay. And that likewise applies for the size of the R market, in the sense that if China is a big economy, for instance, a lot of my exports will go to China, and therefore I have a lot of revenues in RMB. So I want to make sure that my trade credit is also denominated in RMB too, to match those fluctuations. And lastly, the higher the covariance of RW and indeed the volatility of R in the first place, and that works through this channel that I just discussed here. Okay, so let's just sort of discuss how this all plays out in the end. So let's imagine we're in 2009. This is a bunch of firms in Thailand, as I said, and they're all deciding, where to borrow money from to get their inputs and what currencies to price in. Okay, and imagine that basically getting funding in RMB is prohibitively expensive because of the capital controls. So everyone just uses dollars for their trade credit, for instance. So what's going to happen? Well, there'll be a set of emerging markets where their currencies are very, very volatile. Okay, and using LCP just doesn't make any sense. You just price in dollars instead. Okay, which is this region here, and there's some threshold market where these small markets, the firm is indifferent between LCP and DCP. And by assumption, we're going to assume that the firm sells to China in RMB and to demarket in the US in DCP. Okay, but you can see basically that all you really get is a slither of R usage, which comes from the R market, essentially. Now, imagine that we have this policy to try and jumpstart the currency, and in particular a policy that makes trade credit cheaper. So let's say that Benjamin Strong comes in and creates this liquid secondary market. So suddenly it's cheaper for every firm, in expectation at least, to fund themselves in currency R. So there's a new distribution G tilde J, which dominates the previous distribution. Or we do what the PVC did, which it acts as a buyer of last resort. It has a swap line which enables the central bank to provide credit at a known interest rate, essentially. And what that really means is that it puts a ceiling on the cost of funding in a particular currency. So it caps the cost. And you can see Ricardo's and my previous paper on this discussing ceilings and swap lines. So the idea is that the central bank will step in to make sure that the credit is available, it's sufficiently costly. And the idea here is that if you enact these policies, what you do is you sort of cut the risk the firm facing very, very high interest rates in a particular currency, so it's more likely to use that currency. Okay, so even if these policies aren't used very often, okay, they can have a large impact on choices because they provide insurance against the risk of not being able to attain a particular currency. And that's sort of this lender of last resort role of the central bank, as opposed to, say, just providing a direct subsidy to a currency being used, which would be equivalent to a subsidy, but this is more like a regularly used tool. Now, for some firms, the cost of our credit becomes a bit lower, and they start, okay, I'm going to start using currency R instead. Okay, this threshold here has shifted sufficiently downwards, such that I'm going to use R credit. And because they start using our credit, it makes sense to think about, okay, which currency should I price in R? Okay, and there'll be another threshold here which says, okay, for these currencies, the bilateral exchange rate between the Thai baht and this currency is sufficiently variable such that it makes sense to use the R currency instead. If the R exchange rate is more volatile than the D exchange rate, this threshold will be below this threshold here. Okay. As before, we'll have RCP and DCP for the R and D market. Okay. Now, if the central bank and also did FX stabilization, that threshold would shift up. Okay. And because the threshold shifts up, this would also shift to the right too, because the firm wants to align price with marginal cost. And for these firms that previously wanted to use D credit, if this threshold shifts up, they have more incentive to shift to R credit because more of their pricing would then be currency R. So you have this shift up too. And you also can think about how a growing R market would play out. So if the R market grew, then suddenly more of everyone's sales will be dominated in currency R. So it makes sense for more firms to also borrow currency R. So this threshold will shift out. The last thing I wanted to talk about very quickly was this sigma RW condition. Okay, so we discussed this previously, and the idea is that we need our inputs to be either sufficiently important in production or the sigma RW to be sufficiently large. If it isn't, okay, what we'll get is a situation where I think, okay, I'm not going to use RCP, the firm. I'm going to borrow in currency R, but because that has only a relatively small part of my input basket, actually the rest of it is my domestic wages, I'm actually better off using PCP, okay? But if you imagine a situation where suddenly more of my domestic economy becomes dependent on the R market, okay, imagine that everyone exports to China and then domestic wages become more tied to the Chinese exchange rate, and this covariance can rise, and then actually we have a shift from PCP to RCP, and actually this whole threshold here will shift out. Okay, so this is sort of the idea behind this covariance being very, very important. Okay, so let me just develop these pictures into some empirical predictions. I have to move fast, so I have 10 minutes to do the regressions, but I'll try and get through them. So first point is that there will be very, very few international currencies. Many currencies will be too volatile. Their domestic producer will be too small, or their credit will be too expensive to actually become the international currency. Most currencies sort of would fail to have this sort of jumpstart simply because either they're not an important part of firms' input baskets, or because their market that supports them is too small, etc. This idea of using a policy which makes a trade credit cheaper can jumpstart RMB use via the swap line, for instance. But that implies both the payments sent and payments received, right? So it's not just going to China, we're also looking at my imported inputs, but also my exports to other markets too, okay? This idea that this covariance between R and W can be very important. So if I saw countries by R and W, we see a bigger impact of the swap line for those for which that covariance is higher. Otherwise, we may just have PCP here instead. Okay. And the last thing, which is kind of a subtle prediction from the model, is that when I sign a swap line with the R currency central bank, my neighbors start using the RMB too. And that's in the sense that my neighbors may also be one of these export markets, but also the fact that my neighbors are going to use my inputs in their production. So if my inputs are denominated, they also may want to align their currency and their pricing with R. Okay, so let me jump to the empirical section of the paper. So a couple of summers ago, Ricardo and I and a bunch of RAs had some fun looking through PBOC documents, sort of tracing the evolution of these swap arrangements and sort of seeing when they were signed and how much they were signed for. And now we have around 38 agreements in place as of end of 2018, and the cumulative value is 2.7 trillion RMB, which actually is pretty close to the peak drawings from the Federal Reserve swap lines during the crisis. So sort of comparable magnitude, at least in terms of notional amounts. Okay, and you can see sort of the times at which they were signed. There was a leveling off after 2015, 2016, which may just reflect partly the inclusion of the RMB in the SDR basket. The idea is that this is a policy to achieve that goal, and once that goal was over, these tools became less important. Having said that, there were still agreements signed, and they keep on being renewed. So it's not obvious that they were purely symbolic in that sense. Okay, here this just plots the evolution of the network. So what you're seeing here is China in the middle. The darkness of the circle tells you how big the agreement was. So Hong Kong was the first actual agreement. It's a very chunky number. Korea has also got a large swap line, but Belarus is more minimal in size. And then the network sort of evolved over time, with the ECB being the largest recipient so far. And you can see how it looks today, with Japan being the last country to sign swap agreement with China. Fine. So to measure the use of the RMB, we're going to use data from SWIFT on international payments, and that tells you basically at the country pair level how much payments were sent backwards and forwards between the countries, and the breakdown by currency. So how many payments sent in RMB, in dollars, in euros, etc. It covers 9 years of data. This is basically the start of the point where SWIFT collected the currency breakdown, and what it really is cross-border bank messages. So it's messages on basically correspondent accounts. So it's saying I instruct my account with this bank to pay you this much as a cross-border message. Okay, it's not actual settlement or clearing or anything like this. It's purely instructions, and it's basically the way in which banks talk to each other across borders. And SWIFT is the most common way of doing that. Okay, so you view it as a representative sample in that sense. What we don't know is who's making the payment, so neither the bank or the bank's client. Only the currency and the amount is recorded in dollar terms, in fact. So we have the currency and the dollar amount. We can see whether whether it was a payment in terms of like an FX payment, whether it was a transfer between the two different banks. or it was a transfer between a bank on behalf of its client instead. Okay, so interbank versus sort of non-financial payments. I'm basically going to focus on these two in particular, although breaking out between interbank and non-bank doesn't have any effect really. Now, obviously, these are payments, not invoicing or currency of trade credit, but we sort of know from the open economy literature, those things are just really aligned. So the invoice currency tends to match payment currency, as does the trade credit currency. So the measure of interest ends up being, for each country, like what's the RMB share in your cross-border payments sent and received per month per country, okay? So what I'm plotting here is just, what's the average or the sort of total RMB share in SWIFT, so across all countries, all international payments, what share is from the RMB, and it's around 3%, okay, as of 2018, and there's a peak of around 4% in 2015. So it's been an upward trend. It started from basically zero, as I said, in 2011 or late 2010. Hit 4% and sort of leveled off since then. We haven't got, to be honest with you, a good story of what explains the leveling off, apart from the fact there was probably some cap on how big the RMB can be used. And it does actually also align with a leveling off in the swap lines being signed too. Okay, so just a quick word on our sample. First is that, if you look at the plot of the share of RMB in payments against the share of China in trade, pretty much every country is above the 45-degree line. So RMB is used disproportionately less than there is China trade of a country. Still, there are a few countries which use the RMB a lot. So Mongolia, for instance, has 25% of its cross-border payments in RMB. Hong Kong, likewise, even though we actually consolidate it into China in our main empirical analysis. And there are a few countries where they use a lot of China trade. South Sudan is up here, for instance, but they don't use the RMB at all. And in fact, what reached out to us was the idea that many countries actually are at zero. Okay, and this goes back to this jumpstart point. So what pushes countries away from zero? And so we're going to focus on the idea of what's the probability to actually use the RMB in the first place, as opposed to what happens to the share of RMB payments when the swap line is signed. And this picture basically just, I think, summarizes the main regression results. So this is just plotting the months before and after the swap line was signed, and the median country share in RMB share payments. Well, the mean actually looks quite similar. What stands out is basically, you start knocking around at zero, and then once the swap line agreement is signed, after a few months, you start to see this pickup, although the actual magnitude is small here, it's 0.25%. So it's not the case that countries start using huge quantities of RMB once this swap line is signed. So it's primarily driven by smaller flows as opposed to larger ones. Okay, and now obviously there's a number of concerns by sort of like just regressing swap line RMB usage. We're going to throw a bunch of controls into the regression, so just time fixed effects, take out any common factors, country fixed effects. We control for the RMB share used by neighbors, just to basically take into account any regional trends in terms of their relationship with China. But basically all Chinese trade that the country does. And lastly, what's most interesting is Chinese policy. So whether the country has an RMB clearing bank, whether the country is a member of the Asian Investment Bank, various measures of infrastructure investment flows from China. And this is the idea, basically, China's doing a bunch of things to internationalize its currency and expand the rest of the world. Let's try and isolate the effects of the swap line best we can. So just looking at, say, like a simple linear probability model of the effect of the swap line on RMB payments. So starting from a no controls regression, you're getting a 30% increase in the probability that the country will use the RMB in a particular month from the time of the swap line. Once you start controlling for fixed effects or neighbors' share of payments and the various policy controls, it drops to around 15% or so. Okay. I mean, the other approach we took for reverse causality and dealing simplification concerns is that these swap agreements were often signed during a state visit by the Chinese premier. So we had the idea, the calendar of Xi Jinping is slightly random. So let's use those dates instead, and instrument for swap agreements using the schedule of the president and see whether the state visit aligns with it, and use that as an IV. And actually, once you use state visit IV, you still get this effect, and actually the coefficient estimate goes up to around 60%. And the first edge extract is quite strong. So I'm over my time. So let me just look at a couple more things very quickly. So one is, yes, there's an effect on neighbors too. If you look at the neighbors' propensity to use RMB once swap line is signed, neighboring countries increase their usage by they're about 10% more likely to use the RMB, and that excludes even neighbors that ever sign a swap line with the PBOC. If you sort on covariances, if they're sorting on the sigma RW term I discussed previously, yes, you see that basically it's the high correlation countries, so the countries where R and W is proxied by the PPI in this context, but that correlation is very, very high, where we see the effect. Okay, that sort of holds across like no controls, with controls, and also look at payments received. So the sigma RW thing was about exports more than inputs, and so we expect this to be really the way of discriminating what happens. Okay, so let me just very briefly say the following. So if you exclude China, results are unaltered. You can split payment between payment sent and payment received, you get very similar results. Focus on message types we know are associated with trade credit, again, we get similar results. If you look at RMB shares, so the intensive margin rather than the pure intensive margin, there's a 0.4% increase in the share of RMB payments associated by an increase in the swap lines. And actually, this effect seems to persist. So most of the effect actually comes through like after a year and lasts for around 3 years rather than the first 12 months. Okay, let me just very quickly conclude. So what we showed you today is that international currency status depends on really sort of financing of trade and working capital credit, and that means that policy and central bank actions have the ability to influence currency usage via sort of targeting this particular financial market, the availability of trade credit. In the model, we have this complementarity between credit and invoicing, so the currency in which you borrow versus the currency in which you price your goods, and that generates thresholds in the use of the currency. And we argue that, said most currencies don't meet those thresholds. They're either too volatile, trade credit is too expensive, or they're too small in terms of firms' input baskets. And empirically, we showed that if you have this policy to target trade credit, the swap line can sort of remove the right tail risk, and that can increase probability that a country makes or receives an RMB payment. So one thing we can't say is whether the RMB will rise further. We're still far from a situation where the dollar in the 1920s was sort of like this heavily used currency, and obviously the luck of a couple of world wars to not allow the competitor obviously helped the dollar. It's not unclear whether the RMB will ever achieve that status. Okay, I'm going to pause now. Thanks very much, and I'll hand over to Ricardo, I think, for Q&A.
Thank you very much, Saleem. That was wonderful, extremely interesting. Okay, so we've got some time. We've got about 10 minutes for questions. If you'd like to raise a question and ask it directly over audio, what you have to do is click on the raise your hand option at the bottom of your screen, and then I'll kind of give you audio access over that point, and Ricardo will answer your questions. Maybe just to kick off, I'll ask one myself, which is something I was interested in as you were talking. So I'm kind of slightly interested in this question of like how stable the relationships are between the dominant currency here and the kind of rising currency. Does your model say anything about that? Could you have like a situation where multiple currencies are kind of coexisting on a dominant basis together, or is it inevitable that one will kind of push another one out? I think this is kind of interesting in context of, prospects for the dollar going ahead, which is, something that people may be interested in. So any thoughts on that?
Okay, so first of all, thank you everyone for joining, for the feedback. And so let me just answer what David just said, and then there's a question from Jumana that I can answer as well from the chat. On the question, David, our model, so the typical model in this literature is really a model of understanding why a currency is dominant. And so these are models that obviously have very small, lots of forces there that are pushing you towards why you end up with a currency dominating everything. It's actually, either because of strategic complementarities in pricing, or because of a network effects on use of a medium of exchange, or the mechanisms of that type. So in those models, it tends to be that it's very hard to then get one small currency left, because there's a very strong force that one gets 100%. Okay. In many ways, our model, and the reason why we had to write a little bit of some theory here, is precisely to generate why you have a few small ones. So our model does generate exactly what you said, which is, well, yes, there's a force towards being a dominant. We just take that as given, imagine as a dominant. But what leads to some currencies breaking through zero to being positively used? And in our model, we have only, aside from the dominant, which has dominant force, we have one rising one. And we study exactly these three thresholds that, if met, lead to this rising currency to become itself international. And, when you look at those rectangles that we produced, these are relatively small rectangles, if you want, when drawn to scale. That means that adding a second, a third, a fourth rising currency, and such that they would also account for 3, 4, 5%. In other words, adding to our model, not just the RMB and the dollar, if one wants to do it, but also the euro, the yen, the Swiss franc, or sterling, is actually very natural and very easy, and doesn't change things very much. Essentially, because we have these determinants, because these thresholds are going to have some country specificities as beyond the firm variation or the market variation, we could very easily do this. Really, it would almost be a little bit more notation, but essentially no change in the model at all. Because that is what our model is for. Our model also has a complementarity between the marginal cost and the price. That's why you need something to break through. The complementarity in our case is there, David, to push us to zero. Why is it that most currencies are at zero? Because unless you have this complementarity, these different effects, you can't break through zero. But then in our model, they just stay at zero. If you were to add to our model, then all these other forces that the literature studied very well, and they would push then among those that are above zero, one of them to jump all the way to 90%. The difficulty, if anything, as a theorist, would be that those strengths would say that should be 100%, as opposed to the other way around. But anyway, those we could do when the literature is done, which is why that sets up. But our model exactly addresses that issue of ours in the sense of kind of the theory that it does, is precisely generating some that are international but not dominant, and that's what the model does. Now, Jumana asked a question, Jumana Saleem, on to the extent that China is constrained by the use of SWIFT, and thus it's promoting its new alternative called CIPS for the China's hybrid net settlement clearing system. You're correct that indeed China is promoting an alternative payment systems. I would note that according to the data one has, SWIFT is overwhelmingly the operator through which most operations happen. That is, that the CIPS has really not taken off in any particular extent. I would also note that there's nothing about SWIFT that is naturally biased towards the RMB, meaning the SWIFT data has its biases, the SWIFT company has its ways of recording things or not. There's nothing in the manuals, in the instructions, the way they do it, that would in principle bias things to the RMB. The SWIFT is, after all it is a messaging system. It's simply a way for a bank to communicate with another bank that this request comes from a legitimate account and is going to a legitimate account. Now, there's some political reasons, and especially reasons having to do with A, capital controls, and B, control of information, because SWIFT is purely a messaging system. That means that the Chinese authorities would rather have a different messaging system. But it is not the case that, as you wrote, the view that international use of its currency is constrained, that it has to use SWIFT, it has to go through SWIFT, that I find hard to justify, given at least what I know about what SWIFT does. It's rather that if you go through SWIFT, it means that all payments coming in and out of China through SWIFT there's a record of them. And there's a record of them that's swift because each one of them comes with some message. And that is what perhaps Chinese authorities would like to not be completely beyond their control, but it is not an impediment for payments in themselves.
Great. Do we have any more questions? I might take the advantage, as I've got you here, Ricardo, of asking another one. Do you, one thing I really like is the characterization of swap lines as like a backstop mechanism, truncates the distribution of funding costs. That seems really nice. It made me think, like, what would a cost-benefit analysis look like of providing swap lines? Is that something, does your model do that implicitly? Would it simply be a matter of comparing that kind of benefit in terms of the truncation of funding costs to the credit risk involved in the swap line? Or could you say a little bit about that?
Absolutely. No, we've thought about that. I mean, so in the model in itself, because it's essentially just a small open economy and the equilibrium within it, we don't have the tools in it for it to operate. But we can discuss it. And more importantly, the model could very easily be not so much as extended, but plugged into a model that has other trade-offs there. So let me discuss instead what some of the trade-offs are. What we've shown is that by cutting in some of the right tail, the swap line promotes the use of the RMB. First question, David. Why not just do a subsidy, a credit subsidy? Ultimately, why not just say any trade credit, any working capital, any loans from a Chinese bank in RMB would be subsidized. That would theoretically work essentially the same way. And all our propositions, indeed, and we try to make that clear it's just about the shift in distribution. Instead of cutting the right tail, what if you shift the distribution to the left? Essentially it would work out the same in terms of our proposition. In terms of cost benefit, though, you'd expect that to be much more costly. I mean, meaning the subsidy you'd have to pay on every single transaction. Here, de facto, in principle, if you're just removing a right tail in a small sample, it may just be that you never use a swap line whatsoever, so you never pay the cost. All you've done is remove an ex ante right tail risk.
Yeah.
Note that this is in many ways an insight that's not ours, but is due to British economists of the 18th and 17th century, then encapsulated by the famous book by Bahaj, that if you want to promote a credit market in the financial market, cutting right tail risks is the kind of thing that as a central bank, as a financial authority, you can do that's very effective and very often very cheap, insofar as it gets used very infrequently, especially if you combine it with regulation and the right pricing. So that's I think the first point to note on that cost bank. But then, even if you were to do it, what are the potential costs? Well, you could get the pricing wrong of the swap line, not make it penalty enough in the Bahaj sense, and as a result be so used that you'd be much closer to the subsidy. At the same time, if you make it too expensive, then you cut too much on the right tail and you have a much smaller effect. So there's going to be some cost benefit there of exactly where you price it. Next, to what extent do you want your currency to be international? There's some benefits. Potentially, you could say that there's some costs. There's a literature on this, especially very much centered around the dollar, from exorbitant privilege to control over capital flows and others. For a currency that's not 90%, but rather is 5%, what are really these benefits? Much less clear, worth a whole new paper and some people thinking about. I mean, is it really worth having the euro be used 10% of world transactions, or sterling that's used in EU? What are really the gains lost? Because again, the literature is dominated by the benefits of having your currency be 90%. But whether it's 10, we could also discuss what are some of those benefits there or the cost. So I think these are the kind of questions that I would ask if we were to do that. Yeah, so that's just the beginning of what that discussion could be.
That's wonderful. Thank you very much. I think we're pretty much out of time. So I just want to take this opportunity to thank Ricardo and Saleem for a fantastic paper and discussion. And to let you know, we have another seminar in 2 weeks' time by Leonardo Melozzi from the Chicago Fed. So I hope you can join us for that. Thank you very much.
Thank you. Thanks very much.
Bye.
Thanks. Bye-bye.